Singapore's manufacturing sector continued to grow in March, though at a slower pace. The Purchasing Managers' Index eased by 0.1 points to 50.5, marking the 8th consecutive month of growth. A reading above 50 signals expansion. Output was largely driven by a slower expansion in new orders, new exports, factory output and employment. The electronics sector also increased 0.1 points to 51.4, growing for the 10th consecutive month. It was mainly driven by strong global demand for semiconductors, AI hardware and data center components. Despite uncertainty from the Middle East war, one analyst says growth was expected as buyers rushed to place orders before further price hikes.
From the business side, manufacturing side, we certainly have seen still very resilient manufacturing activities on the back of businesses still rushing with their orders, factories completing orders, factories getting input despite having to pay more because there's a worry that they may have to pay more in subsequent months. So we'll see how they play out in the next couple of PMI reading, and how that will play out clearly will depend on the situation in the Middle East.
And for more, I'm joined by Bernard Au, Chief Economist of Asia Pacific at Coface. Bernard, thanks for joining us. Supply chain disruptions and soaring factory costs due to the Iran war have distorted headline PMI readings globally. Now, how does Singapore's performance compare against other regional economies?
I think for the month of March is quite too early to tell. As you can see from the Singapore manufacturing PMI numbers, we are still in growth territory. What I'm actually looking out for is the input cost price index, the sub-indexes, as well as the supplier delivery time, both of which have significantly moved up, as well as down for the deliveries. So for example, for the supplier's delivery time is the highest since the peak of COVID time, which is almost 6 years back. So what this tells me is that deliveries is getting longer, the delivery time is getting longer, so that could then filter into companies unable to get some of their supplies in time or their raw materials in time for production.
I mean, you're right, headline, PMI numbers have expanded, but growth has eased. What do you make of external demand? Is it going to be cooling further?
I think if the current situation in the Middle East persists, that may well happen. And as you know, Singapore's economy is heavily dependent on external demand. So should that happen, external demand starts to slow, that will have a knock-on impact on Singapore's economic growth. And we could see then the sort of rosy prediction that we have before the war starting to come down to less than 2% growth for the whole of 2026.
Now, electronics PMI remains a bright spot, right? It's edging up to 51.4 points, but we're already seeing signs of the conflict straining access to key chip-making materials like helium and bromine, and high energy costs from oil price surges. How durable do you think is the growth of this sector? Can it continue to outperform?
So I think for many sectors, including electronics, the issue going forward will be getting enough inputs, components to ensure that production can be carried on. And which is why when we look at even the sub-indexes components for electronics PMI, the delivery times, it is also lengthening. So that could have a knock-on impact on the production side. We have seen, as of in the month of March, we have seen Singapore's refineries and refineries in Southeast Asia cutting production run. And I think that may well happen to other sectors, including the electronics sector, should they be unable to secure inputs in order for them to continue production. So they could possibly cut production run, and then that will impact economic activity as a whole.
Now, inflation, of course, is always a big question mark. Do you see rising production costs driving up Singapore's inflation, even as the PMI readings remain expansionary?
I think for the inflation itself is going to be driven up by many factors. Of course, a lot of them have to do with higher energy prices. That will be translated into higher electricity tariffs, which we have seen SB Power announce just a couple of days back. Higher energy prices will also filter into logistic costs, transport costs, higher freight costs, and all this is going to come into play when we import things like food and essential items and any other groceries. So that will definitely filter into the headline consumer PMI CPI numbers. And as we know, the food component is comprised somewhere about 20% of the CPI basket. So definitely that is going to have an impact on the inflation growth rate going forward.
All right, Bernard, thanks for those insights. That was Bernard Au, Chief Economist of Asia Pacific at Coface.